Hello and welcome, dear investors. Conagra Brands is one of America's leading food companies and shines with an extraordinary high dividend yield of close to 5%. Yet this company is unknown to many investors. Are dividends safe and is the stock a hidden gem or rather a value trap? I tell you right now. Me is Thorsten Tiet. I'm the founder of Dividend Stocks Cash. It's all about investing into high quality companies to profit from long-term capital gains and growing dividends as well. So we have Conagra Brands to analyze. Let's go. First thing which makes this company interesting is, of course, a dividend yield of 4.93%, and you can see here in the dividend turbo that this dividend is extraordinarily high compared to what you got the previous years. It's even on 10-year high. If we zoom out a little bit, we see that, for example, during financial crisis, you got more dividends, even more dividends for your bucks, but this is already 14 years ago. This current dividend yield is extraordinarily high and might open up a nice buying or investment opportunity. This stock in general, it is a slow grower like so many consumer staples. This translates into scorecard values, which makes this stock good for dividend income investing. Dividend growth already less and earnings growth, if you don't care for dividends at all, this stock is not really for you. What we can say also about this stock is the total return analysis. So what you expect, how much capital gains and how much or how many dividends. And we can see it here. If you just look at the stock price and when we start in the year 2000 until right now, then you see a very sluggish annual yield of just close to 2%, which is really an underperformer. Also note that the stock dramatically lost some of its value from more than $40 to just $27.50 right now, which also might indicate nice buying opportunity. But if we add dividends to your overall yield, then you see that it looks already much better, and then we get a higher return. If we invest into the stocks, close to 2% improves to more than doubles to at least 4.5%. 4.5% is still underperformance compared to the general stock market, but we will see very soon in the valuation that the stock might be trading right now with a heavy discount, which makes it a buying opportunity. But first, let's look if dividends are safe. We can do it here in the quality check, and here we see the dividends. We see already some dividend cuts, at least 2 or 3 dividend cuts even. 2 dividend cuts here around 2005 to 2005, 6, 7, and then here dividend cuts around 2017, 2018. There is a big difference between reported earnings and adjusted earnings. You can see it here. Adjusted earnings are in general higher than reported earnings. This is due to impairments and discontinued operations. This company invented itself several times. You can see it here with the by showing the most important balance sheet items. This inner small bar here, this is these represent the complete assets of the company, and you can see that sometimes the assets shrank, like here from 2013 to 2017, or also here. And now, for example, last time the assets grew again. This was the acquisition of Pinnacle Foods, if I remember well. And we also have a lot of goodwill here, which might indicate a little bit a risky position. Anyway, let's check if dividends are safe. So dividends are nicely covered by adjusted earnings per share, but also by reported earnings per share. Right now we are here, this is the present, and we also have positive earning estimates which correspond to the management outlook. Management says that for the current business year, earnings per share should be somewhere around $2.70 to $2.75. Analysts are even a little bit more pessimistic with $2.68. And then we have medium growth rates. We will check at this when we look at the valuation. If we take a look at the free cash flow, then we see that the dividends are covered as well, although closely in the last business year and in the last 4 quarters already got much better, and according to analysts it gets even better in the near future. So dividends are covered by free cash flow, luckily, because the balance sheet itself is rather weak. We have here dividend outflow of cash of 631 million in the last 4 quarters. This compares to a free cash flow of close to 800 million US dollar, though the dividends are covered, but pay attention to the cash of the company. This is rather low with less than 100 million. So if the free cash flow is negative, they could not afford any longer to pay dividends, then a dividend cut would be needed, or they could make take additional debt, but with the current interest rates this would be not a good option. So it is mandatory for this company to have a positive free cash flow, or a free cash flow which is higher than the amount of dividends paid out. But so far it works, so dividends look to be safe right now, and according to analysts they will be safe, even safer, more safe in the future. Let's check the fair value. This makes the stock also interesting, or there are two arguments why the stock might be a buy. First is the high dividend yield, and second could be a nice valuation or undervaluation. The stock currently trades with a multiple based on adjusted earnings of below 10, and you can see here very nicely that it is far below the historic average multiple valuation when the stock traded with multiples of even above 20, 24. And now let's have a look at the fair value based on adjusted earnings, and this is the fair value line here. We can even prolongate the calculation. Then I already did it before. Then the average goes down a little from 13.6 to 12.4, and this is a more conservative approach. And here in this conservative approach, the fair value of the stock for the current business year would be $33 US compared to only $27.50 US, which gives a nice upward potential, and an annual yield expectation of 15% till the mid of 26. This 15% is not the annual yield you can expect forever, but this is a higher yield because the stock trades that low, and if the stock reaches its fair value, so you get an additional boost of your return. The organic yield to expect for the next 2 years would be close to 8%, 7.9%. This comes because we have here expectations of adjusted earnings growth, which is as high, so you can expect an annual yield which is that high, which is all rather nice. You can be more conservative, of course, and just saying a fair value of around $36 US is too much. I don't believe in that, not in the near future, because we have some facing some headwind right now. We have less discretionary spending of consumers, which means they are switching to less expensive brands or buying less at all, especially frozen food suffers right now. This is one of the segments because they already have frozen food at home. It's long lasting, and before buying new, they consume what they have at home, but this should be short-term headwind. And I think will get better again. This is also what management thinks. So the fair value indicates a nicely valued stock, and if you go down with the fair value from 36 to, let's say, $32 US, and this is where the stock traded previous lows or around, and you still have an annual yield of double-digit rate 10.5%, which is still nice for such a stock. Of course, there are a lot of other stocks in consumer staples with food or other stuff paying nice dividends, but Conagra Brands is one of the forgotten stocks, and I think it was worth little analysis like this. And if you are really in for dividend, if you're really a dividend income investor, this stock might be a nice buying opportunity for you right now. Okay, what do you think about this stock? Let's drop a comment below. Happy to discuss. Maybe you also want another stock to analyze, and you can write me your wish as well. Thanks for watching. See you next video. Bye bye.